Okay, so what we are looking at here is some input from experienced investors. And what we did, we asked them what did they wish they knew about investing. Now, the first point here, they've stated, I wish I had known that you don't have to know a lot about investing to get started. That's absolutely correct. So obviously, with investing, there's experts, there's beginners, there's all sorts of different levels of ability. And it's absolutely true. You can start at any point in terms of saving and investing. Nobody has to be an expert. And this is coming from experienced investors later on. So just to let people know, don't be daunted by the fact that just because you don't know everything about the situation or investing doesn't mean you can't get started. Next one. So in terms of this comment, I wish I knew that there was so much information regarding investments. It's absolutely correct. There's a wide amount of knowledge available, whether that's online or through various forums, different avenues. Research is very important, especially if you're going to be putting your hard-earned money and wishing for that to grow. So research is definitely something that you should definitely be encouraged to do before you start your journey. Next point, Rohan, thank you. Okay, so I can get a government boost for a house deposit or retirement. Yes, certain savings products do get contributions by the government in terms of bonuses. For example, a lifetime ISA or a help to buy ISA. The government do have certain bonuses that they can provide in the example of retirement or house deposit, which we'll go on to in the presentation. Okay, if we move on. So where to start in terms of how to start investing if you are new or if you just wanted some further tips on your journey. As obvious as it sounds, we need to organize our priorities before we do set a goal, knowing our habits and also knowing exactly what our priorities are in terms of what we're wishing to achieve from saving. We've mentioned borrowing safely. Ultimately, it's about, there's nothing wrong with borrowing, but we need to make sure it's affordable if we do get offered credit or any credit product for that matter, and also making sure we're not paying very high interest rates. Do shop around, etc., if you are indeed borrowing money. So it's about being responsible and efficient with the amount of money that if you do borrow, in a sense of credit cards, etc. Establishing emergency funds. Now, it's quite ironic to state you should have emergency funds in where we are at the moment with Corona. Obviously, people have been impacted by losing the jobs, etc. But establishing an emergency fund is a great way to get started, and it's also helpful to save for a rainy day when people do hear about that. It allows us to be flexible as well in the event of something changing. We never know what's going to happen tomorrow. I'm sure everyone has experienced some unplanned for cost going forward. So that's definitely something we'd like to promote there. Setting up long-term savings and deciding whether to invest. So obviously organizing our priorities, etc., is important, but setting up long-term savings in terms of what we want to achieve, how much we want to save over a certain amount of time, and whether investing is something that will be applicable to you in terms of achieving that goal. And finally, considering seeking advice if unsure. Ultimately, the information is at hand in terms of researching your own, but financial advice is always something to consider if you did want to run that by an expert. That does come at a separate cost. So just looking at the starting points there, important we do stress those. Right, so benefits of budgeting. Just wait for that to load. Okay, so the whole point in us managing money and trying to inform people today is to see how efficient we can be as possible in terms of achieving those savings goals. So to achieve your goals sooner, we do need to avoid wasteful spending. So for example, if you do know your habits in general, if you do like to have an expensive taste of buying too much coffee all of the time, or you are aware of certain habits of spending, be realistic with setting those goals. It is important to set these goals, but at the same time, do be realistic. So do avoid wasteful spending and try and do some research before you do pay for certain things, especially when it comes to prices. We can always shop around. Avoiding short-term debt. Nothing wrong with short-term debt, but we do also need to realize what short-term debt can bring depending on interest rates. If we're paying high interest rates, it's not the most beneficial, especially if we're trying to save as much as possible. If we are paying quite high interest rates to a particular product, that money could go elsewhere and it could be more efficiently used. So these 2 points that we've mentioned are all part of budgeting to achieve our goals. Lower outgoings. Everybody wishes they could do that, but is helpful. Yeah, so we will come to that in a moment. So just looking at TJ, short-term debt. We've just mentioned short-term debt, but Rohan, did you want to elaborate on what I was?
So short-term debt. So there we'd be talking about payday loans. So something that so when you're borrowing money for a really short period of time, maybe a month or two, that's opposed to long-term debt when you're paying it back over years. Maybe, a common example of a long-term debt would be a mortgage, but even sort of borrowing money for a car or something where you pay it back over years. Generally, your interest rates are lower, whereas short-term debt, when you're paying it back over a month or two, credit cards and so forth are another example of that. It can have quite steep interest rates.
Exactly. So hopefully that's answered your question, TJ. In terms of short-term debt, we're just emphasising the points of short-term debt can tend to have high interest rates, which we do need to be aware of. We mentioned lower outgoings, ultimately, that's about budgeting and seeing what comes in and obviously what goes out. We can always be sharper in terms of what we spend our money on. Obviously, looking at what goes out, spreadsheets, whatever works for you, but lowering outgoings will give us more money to put away to save and achieve our goals. So increasing our capacity to save, so lowering our outgoings essentially allows that to happen. And as a result, the collective cycle, what we're talking about here, all of these points we're stating, to achieve these goals sooner, it's important we do stress budgeting. So the points we did make here, it's about sticking to that budget and being disciplined so we can achieve these goals sooner. Next slide, please. Thank you. So in terms of, thanks Sibs about the template there. So in terms of getting some interaction together, we should all be logged into Slido now. I know we've got some new people who've just come into the meeting. So the exercise here is a simple one, but what we're trying to do is get some feedback in terms of how you would apply these. So we're going to go through each one individually. And if you could just go on to Slido, we're going to go through each question individually. So how would you pay for the various different topics that we'll mention? We're just loading it up now. So the first part, I'll give you a moment to answer, is how would you pay for flights? Now, bear in mind, you can just use one payment method. So whether it's credit card, debit card, or
Sorry about that.
So just out of interest, if everyone can answer that, how would you pay for your flights using one of those methods? Yes, we've got a few answers there. Let's wait for a few more. So originally we were seeing a high amount of people responding to credit card, some also going with debit card, and we've got no loans there. So obviously it really does depend on your individual circumstances. Now with paying for flights, I can see the response here. The majority of people have stated credit card. Now, there are benefits to paying for a flight with credit cards. A lot of credit cards can tend to have insured payments, if you will, especially if you're paying for a flight. There's nothing wrong with paying for a flight with your debit card, obviously, if you do have that money available. So it does depend on your circumstances, but it's good to see exactly people's responses to that question. You okay to move on, Rohan?
Yep.
Thank you. The second question, same again, please. So how would you pay for your car using one of those payment methods?
Interesting.
We're getting some interesting responses here. Good to see.
I mean, I guess if you're going to get the car, that would be a different answer. But then once you're making your monthly payments, that would be maybe also a different answer. So is this about buying the car initially from a dealer?
Yes, initially.
Yeah.
Doesn't necessarily have to be a dealer, but yeah, it's all about actually paying for the transaction if you were to pay for a car.
Okay.
Just wait for a few more responses.
If you weren't able to get on Slido, you can just use the text and I'll update that on Slido. Okay. You can just use the text function just to put your comments there, and then we'll update that on Slido.
That's okay. So thanks for the responses there. So we've got a mixed response there. Again, it does depend on your circumstances. We wouldn't ideally be wanting to pay for a car, ideally on a credit card. It really does depend on the purchase type, if you will. What we're looking at here really is it depends on your circumstances. So, for example, if you do have the money to pay for a car, it would be ideal for you to use the money that you have available. At the same time, there are car loans available. There are all sorts of loans. So if that is more beneficial to you in terms of shopping for a low rate of loan. So we are hovering around either a loan, depending on if you can get a car loan or whatever that may be, or your circumstances where you do actually have the money available to pay via a debit card. So thank you for that. Next one, please. Okay, so everyone's favorite, paying for dinner with friends. If everyone could just answer this so we can get an idea of what everyone's thinking of here. Yeah, so it looks like we've got a unanimous winner here. Debit card ideally would be ideal to use, obviously if the money's available. We wouldn't ideally be wanting to use a loan to pay for dinner with friends. There's nothing wrong with using a credit card generally. It can benefit you to use a credit card, especially from a credit score point of view, just starting that journey, if you will. Using a credit card, if you were to use a credit card, it would be ideal for you to pay that off straight away, obviously, otherwise, and then you'd be lending that money, borrowing that money if you were not paying that off straight away. So great to see everyone would use a debit card, and good to see everyone is paying for all the friends' meals as well. That wouldn't be me, but sure, go ahead. Okay, next slide, please. Right, so our next point is we'll do another interaction here using Slido. What we want to ask you all to input is where do you think the highest interest rate would be in terms of the orders that we have that you can see. So if we go to Slido and if you could choose the highest one, and then we'll discuss exactly how it goes in priority of interest rates. So if everyone could answer which one would be the highest interest rate based on what you think.
Okay.
Okay, so we've got a credit card answer here. Oh, now it's getting more interesting. We've got overdraft, We've also got credit card. Interesting. Yeah, so nice.
Big spread, yeah.
Yeah, big spread. Great to see. Personal loan from the bank. Okay. Okay, so thanks for your input there. Great to see everyone's responses there. So let's take a look at exactly which is the highest, and we'll see the how that works in terms of going in order. So with interest rates, payday loans tend to be quite high, very high interest rates, because it's such a short-term amount and the amount being borrowed. So payday loans tend to be the highest. So well done, whoever said payday loans. Overdraft, again, if we look at exactly what the purpose is, you are effectively borrowing from your bank, usually with an overdraft, and that can lead to higher interest rates than possibly even credit cards at times, depending on how long you're in that overdraft. Credit card will be next. Obviously, there's different types of credit cards and there's different types of interest rates depending on what you've chosen. Personal loan, that would be on the lower side. Again, it does depend on the type of loan you get and the percentages or the interest rates that you'll be paying back. Or mortgage, because it's a long-term investment and you're borrowing effectively to purchase a house, that tends to be on the lower scale compared to the 6 that we've looked at. And then, well, depending on if your family members do charge you interest, which would be scary, but borrowing from family would obviously be the lower one there. So thank you for everyone's input there, and it's good to see everyone interacting there and seeing what everyone's insight is into interest rates. Okay, if we move on to the next slide, please.
Yeah, and I'd add on that,
That's me.
Zain, is that, you know, I'm looking at some documentaries in America about how the Somali community has raised funds based on the cultural elements of lending each other.
Okay.
Where families that have come from migrant communities enter, I think it's Chicago, that I think that area was actually shocked on how fast migrant community ended up owning homes, because they were all chipping in and helping one person to buy it, and they were not actually going to any of the banks, and the banks were absolutely shocked how this thing was happening. And we've also got, you know, some of those examples here in Bristol, in terms of what the Caribbean community call like the susu, where people kind of chip in to help out. In South Africa, they've also got these like honey pots, where people contribute in order to, you know, I'd say alternative financing within communities. So interesting how obviously that has got a lower interest rate, but it's more about the trust of the network and of those people that say they want to affiliate themselves within those clubs, and how that can obviously help to go past that interest rate stuff. You know, so really great to see that.
Yeah, absolutely. Networking and community based, where if you're not getting the opportunity from banks, where banks aren't happy to lend, the positive aspect, what you said, there's a community coming together and working for the whole community. And as a result, we're able to jump on the property ladder and the various examples you just made.
Yep. So with all of that in mind, then let's take a look at actually how does money work? How does money work in the economy and so forth? And how do we build and grow our own investments? So what I'm going to do is just, if it ever moves, there we go. Is take a look at us as the individual and the things that we do with our money, where we put it, how we can make it grow, as I say. So the first thing most of us do is keep our money in the bank. Nothing wrong with that. You put your savings in the bank, and often the bank will pay interest on our money. So we see our money in our bank account sort of tick up very, very slowly. So where does the bank actually get this interest from? Well, it in turn takes our savings and then lends it to companies. And companies because they're borrowing money, they owe interest, just like we do when we have a debt and we have a credit card or whatever form of debt it is. They pay interest to the bank, and then the bank passes on some of that interest to us. What does the company do with that money? Well, hopefully they're going to invest that in their products, their services, and get bigger. That's what that graphic is supposed to show. And therefore they can continue to grow, they can continue to service that debt, continue to pay that interest. Now, we can skip out much of this middle section and we can own slices of that company. That's what a share is. It's a small ownership of that company. Or we can lend money directly to that company instead. It's a fixed interest security, also known as a bond. Now, when you own shares, so at the top of your screen there, if the company does well, then your shares will get larger, but also if the company does well, it should make a profit and it can return some of that profit to you in the form of dividends. It's effectively an income payment from that company. They're just splitting up the profit that they've made between different shareholders. Also, with those fixed interest securities, with those bonds at the bottom, instead of paying interest to the bank and then on to you, they'll skip out the middleman and pay it directly to you. So they pay a lower rate of interest than they would have done to the bank, but you get a higher rate of interest than you would have done from the bank. So it's sort of a win-win for you there. So that's how money works and money grows in its most simplest term. And I will come back to this in a few slides' time. But what I want to do here is show you how different assets have performed over the past 25 years. So what we've got here is a 25-year graph, 1995 to this year. And I should just say that this data ends at the end of September. So it's about a month out, and that's just because it takes a while for us to compile and put together these graphs. At the bottom here, you have cash. So if you had £1,000 in the bank 25 years ago, got the small amount of interest that we're used to getting from a high street banks, your money would have grown. It would have grown to just shy of £1,500 today. So definitely would have grown in nominal terms. Now, this next line here is inflation. Inflation sees the costs of goods and services rise over time. So if you tried to buy a basket of goods costing £1,000 25 years ago, and then try to buy an equivalent basket of goods today, it would now cost you closer to £2,000. So that money that you put in the bank, as you can see from this graph, just wouldn't buy you the same amount of stuff over this long 25-year period. I suppose the example that I normally go to is a Freddo. Hopefully you're all familiar with the small chocolate bar of Freddo. It used to cost about 10p, it's now about 35p, and that is just inflation effectively taking hold. And that's, as I say, a small example of a chocolate bar, but that doesn't just affect chocolate bars, it affects pretty much every product and services that we can think of that we use. So here it's important that we look at investing our money over the long term so that it can keep pace with inflation or potentially even grow faster than inflation. So the first, well, I was about to say the first line here, I suppose it's the third line, what fixed interest securities were, what bonds were. So it's when you're lending money to a company and getting an interest rate back for that. And then, of course, when that loan matures, you get all of your money back as well as that interest. Well, gilts are UK government bonds. You're lending your money to the UK government and they're giving you an interest rate back for that. The UK government has never defaulted on its debts. It's a really safe, secure lender, but nonetheless, you can see it's got some peaks and troughs within it. So this just shows that investments can fall as well as rise, and it also shows that having a long-term investment horizon is quite important when you are putting your money into stocks and shares. Nonetheless, if you had lent the UK government your money 25 years ago and you'd stayed the course, you'd be able to buy more than double the amount of stuff you were able to buy back then. So it would have paid off, even though there are those lumps and bumps within it. And then the last sort of line here is the FTSE All-Share. It's a measure of how the UK stock market as a whole has performed, how different company shares have performed. It's the most volatile line because with a share, you own a small slice of a company, right? So the value of that company can drop, and it can drop quite considerably, or it can go up quite a lot. Now with bonds, because you're lending your money, you know how much you're going to get back, provided that the company doesn't go bust. Whereas with shares, it's much more volatile. It depends on whether people are buying that company's products and services. Over the long term, shares have historically outperformed all other asset classes, but you do really have to hold on to your hat. You can see it's quite a bumpy ride. You've got the dot-com bubble here. You've got the sort of financial crisis around here. And then you've got a really sharp drop with the coronavirus pandemic, and then a little bit of a recovery. Now, if I move on to the next slide, peak to trough, it was a 35% drop this year. So I think it peaked at the end of February, if memory serves, and then bottomed out on the 23rd of March. That's a huge drop. Now, as I say, it has recovered quite well since then, but you would need to be willing to, as I say, to really hold on to your hats as you take that ride. Now, let's have another exercise, a little bit more of interaction. Just going to have a look at a couple of companies and see which you would rather have shares in. So the two companies are hopefully companies that you've heard of. The first, Coca-Cola. No doubt you've had one of their beverages or products in the past week or so. And then McDonald's, well, you may well have seen them relatively recently as well. I just bring up Slido again. Move on to the next slide here. Let's see which company you would have wanted to invest into over the past 10 years. Now, this is by no means an endorsement of either of these companies. It's just to see which you think has done better, a bit of fun, so to speak, and we'll see how they've performed. All right, so Coca-Cola in the lead. All right, should we give it another moment, just see if there's anyone else who wants to put anything else in?
Yes, and for those who have just joined, you can use the text box if you're not on Slido, just to put your suggested comments, and then we'll add that onto the slide. All right.
And just whilst you think about this, the other thing, sorry, I forgot to mention earlier on, is we will go back to the Q&A that's in Slido as well at the end. So I will refer back to that. So if you do have questions as we go through Slido, you can use the QR code on your screens now, or hashtag HL Money Talks. And at the end of this presentation, we'll definitely look to address your questions. So please do use that function as your questions pop up, come to mind, and then we'll come back to them. All right, so let's bring that slide back up. Okay, so we had a clear winner. Everyone wanted Coca-Cola. Let's see how they've performed, shall we? So
we had one text for McDonald's, or two texts.
Great.
Two texts.
A couple of people want McDonald's. I like a little bit of diversity there. That's good. Let's see how they performed. So it's a 10-year graph up to the data is up to the end of September as well. So it's consistent with all the other data that I've shown and will show throughout this presentation. So at the bottom, we've got just the price of Coca-Cola shares. Now, as I said earlier on, with shares, you get the performance of the shares. So if people are buying those products and services, then the company's value will increase or decrease, but also you'll have some income payments. So this is just the price of Coca-Cola shares. And then we've got McDonald's. Now you can see that McDonald's has outperformed. So if you had £100 in Coca-Cola 10 years ago, today they would be worth about 160. If you had £100 worth of McDonald's shares 10 years ago, then that would be worth significantly more, about £300 today. Now let's see what happens when we start to put in the dividends. If you've taken your profits and you'd reinvested them back into these shares, you can see it does make a significant impact on the performance of that stock. So you've got that stock that performed at about 60% return, you've now bumped that up to about 140%. So that's quite a significant impact over those 10 years. And again, if we do the same with McDonald's, you move from a 200% return to a 300% return. So it's really important to look at the impact of those dividends, of those profits, because that is effectively the effect of what we call compounding. And compounding is when you take a bit of money and you add on a few percent to it each year, and then you take that extra percent and then you add it on again and again and again. And this is a really good key concept that we'll be coming back to later on in the presentation, because I appreciate it's not an easy one to get your head around, but it's important that we come back to it and flesh it out so that we do begin to understand what it means for us and what it means for our savings in the future. So what I've done over my slides so far is I've focused a lot on investing. It is really important, though, to note that investing isn't right for everyone. I've shown you that investing can go up and it can go down, and over the long term, investing tends to pay off, or has done historically. But over the short term, you may lose money, and that's why putting all of your money in the stock market is perhaps not the best idea. So there's a time to save in cash and there's a time to invest. So what's what? So when we look at an emergency fund, this is generally sort of 3 to 6 months worth of expenses. This is something that most people should aim to have. If your car breaks down, if the boiler breaks, if there's any unexpected costs, it's good to know that you've got a little bit of a buffer. I mean, right now we're still in this pandemic, aren't we? So some people will unfortunately have lost their jobs. Just being able to know that you've got a little bit of money to tide you over is a good thing. And that emergency fund should be kept in a relatively accessible cash account. If you're saving for any objectives that are in the short term, and when we're talking the short term in investment terms, we're talking of anything less than 5 years. So if you've got an objective to, I don't know, buy a new car or in a couple of years' time, or do up the kitchen, or whatever it is, and that time horizon is less than 5 years, then we're looking at saving for that in cash. Now, the benefit of that is that your capital is normally secure. Banks in the UK typically get financial services compensation scheme of up to £85,000. So your money is fairly secure. There's a minimal risk of loss there. Though the interest rate is low, you're not really going to get inflation beating returns very often on cash, which is sort of the downside of saving in cash over the long term, which is those last 2 points on the left hand side of your screen. On the right hand side, you've got investing. So when we're looking at investing, we're looking at objectives of 5 years or more. Generally speaking, people either invest for income, and that's so that they can generate a further income. This often applies to people in retirement, but there can be a whole host of reasons why you might want income producing investments. Other people invest for growth so that they can try and grow their capital, grow their money, and then others will go for a combination of both, and different investments will be right for those different objectives. It does give you a greater potential to get returns on your investments, a greater return, as you can see from some of those previous slides, but there is that risk that the capital's not secure. So you may well beat inflation, but there is that risk of loss over the short term. So it's really important to have a long-term horizon. So with all of that in mind, there's a whole host of tools and so forth that you can use to choose your own investments. And we're going to go through a couple of those now, and I'm going to invite you to explore the HL website as well, so that you can see some of those other tools that we have available, so that you can make your own well-informed decisions. Just to go over this again though, I just wanted to go back over what a share is, because this is one of the most important things and concepts to understand. So you've got your company, it's a PLC, a public limited company. And that company is split up into individual shares. So each of those boxes represents a small slice of that larger company. Now that company's share price can go up, and what that means is that those shares, they'll expand in size. You'll get a larger slice of the cake, so to speak. And equally, there are times when share prices fall. So why do they fall? Perhaps quite timely given the past few months. So you've got falls and profits. So if we think of companies that service companies, you've got your Cineworld, your restaurant groups and so forth, companies that people haven't been able to use so much, they've not been making as much money, there's been a fall in profits. So their share prices has dropped commensurately. The change in risk appetite, your risk appetite as an investor may well change. It might not be right for you. You might sell your shares. And if that's the same for a lot of people, fewer people will be buying that company's shares than selling them, and that can result in a drop in the share price. And uncertainty, well, investors do not like uncertainty. Investors will try and move to safer assets, something that they have faith in, and that can also result in people selling their shares and dropping the share price there as well. Now, the good news for many of us, myself included, is that we don't need to make day-to-day investment decisions if we don't want to. You can entrust your money to a professional to make those day-to-day decisions for you, and that is what a fund effectively is. So a fund is where your money is pulled together, it's handed over to that fund manager, and that manager chooses which shares, which bonds, which properties, which other assets to put your money into, and sees, as I say, effectively how to manage it. So what's really important here is to choose a fund whose objectives, broadly speaking, align with your own. So if you're really into your tech stock, finding a fund that does that. If you're into your consumer goods, then find a fund that invests into that. And there are funds of all shapes and sizes, so you can really find one that, as I say, fits your own individual objectives. Now, a word of caution here, not to put all of your eggs in one basket, though. So the key buzzword here is diversification, but it is also the main way to reduce your risk. So what I've got here is an incredibly colourful slide that probably doesn't make a vast amount of sense to you if you look at it initially. So let me just start by explaining what that slide shows you. So it's got a whole host of years on it. They're full calendar years, which is why 2020 isn't there. And at the very top, you've got the top performing global sector. At the very bottom, you've got the worst performing global sector. So you've got Asia, UK, Europe, so excluding the UK, North America, so US and Canada, and then Japan. So these are the largest sort of global regions, global stock markets where companies are based. And they're color coded, so Asia's always in red. You've got the UK always in green, Europe in blue, North America in yellow, and Japan in grey. And you can see here that there's no consistency. The red, so Asia Pacific, is not always at the top. It's at the top quite a lot, but it's also at the very bottom quite a lot. The UK is all over the shop, so is Europe, so is North America, as is Japan. The point here I'm trying to make is you cannot predict the future, or if you can, you're far better at it than I am. You cannot tell from this which global areas, which regions are going to do better in the future. So what do you do about that? Well, you have a bit of your money diversified throughout all of them. Now, I could have done this chart with different sectors. I could have had sort of your consumer goods. I could have had your restaurant groups. I could have had your tech groups, and you would have a really similar mishmash of colors all over your screen. So the point here is to try and have sort of your finger in lots of pies, so that when something doesn't do so well, then you've got other assets that hopefully bring it up, and when something does really well, that you benefit from that as well. Okay, hopefully that all makes some sense. We're just going to touch on your account options or briefly, and then I will hand it back over to Zane to take us home. So there are different accounts for different circumstances. There are investment accounts with tax wrappers. So you've got ISAs, so these stand for individual savings accounts, and investments and cash held inside an ISA is free from UK income and capital gains tax. There are different types of ISA available. If you're aged under 18, then you may be able to open a junior ISA. There are cash ISAs, so if you want to be saving in cash, then you can get tax-free interest on your cash savings. If you want to invest and you're aged over 18, then you can open stocks and shares ISAs or general investment accounts. And if it's in an ISA, as I say, it's free from UK income and capital gains tax. If you're saving for your first house or for retirement, then the lifetime ISA may be of interest to you, as you do get a government bonus with that. You've got pensions. So with a pension, you'll get effectively a government top-up, a tax relief from that as well, if you are saving for your future. And if you are employed, then you can make contributions via your employer, and you may get further tax benefits in the form of national insurance contributions, as well as tax savings, and your company may well contribute to your pension as well. So if you are employed, well worth exploring that. I'm not going to go through all of these accounts in detail for you, but if you do have specific questions on that, then do let us know in the Q&A function on Slido, and we'll certainly address that at the end. On the HL website, hl.co.uk, you'll find loads of details about all the products and services that we offer. But there are services that we don't specifically offer as well, such as cash ISAs and so forth. So it is up to you to, as I say, make your own decisions. But if you do have questions, we are there to help you and to answer your questions as well. Okay, so I'm just going to hand over to Zane here to take us through the next few slides on the impact of starting early. I just need to unmute yourself.
Just unmuting myself there. Do that every time. So thanks very much for that. So in terms of starting early, we did mention about compounding, or Rohan mentioned before. Let's just take a look at an example of a pension that we'll see in a moment. So starting early does put you at a benefit, especially if you are trying to achieve your goal. So if we move to the next slide. So what you're seeing here is evidence, if you will, of starting early based on savings. So what you're seeing here is, imagine you effectively want to retire at a respectable age, the way it's gone at the moment. Most people do retire 60, 65, 70. We don't know what the case may be in the future. But looking at a pension example here, if you wanted a retirement income of £20,000 a year, in order for you to achieve that goal, depending on how old you are and how early you start, the evidence is here. So what we can see here, someone who's 20 years old who wants to achieve this goal of that amount of money per year once they have retired, they would only need to put £93 in to achieve that goal. Whereas if we look to the other extreme version there of being 40 years old, to achieve the same goal, you'd need to put £303 in per month. Now, it's not as simple as stating, because you started late, you need to put more money in. There's also the major point that Rohan mentioned about compounding. The earlier you are in, the more benefits you will get on those gains over time. So the almost a snowball effect, if you will, that large amount of savings growing over time, as opposed to just starting pretty late. You would still have a compounding overall growing effect, but the longer you are saving, the greater that compound effect will be. So just looking at what we've mentioned there, this is a perfect example of starting as early as possible. From a pension point of view, Rohan mentioned before, a pension is encouraged by the government. So starting early is certainly something beneficial to do. Contributions would come from your employer, so employers do have to opt in their employees into pensions, and also the government do also provide tax relief, so an additional bonus, if you will, based on how much you've contributed. So hopefully everybody can see the evidence here in terms of the longer you are in that market, if you will, in that saving journey, the greater the benefits of gains overall. Okay, if we move on to the next slide, please. Thanks, Rohan. Right, so things I wish I had known in general, and this is everybody, so not just me, but a general investor, if you will. So some key points to take away from here: opt into your workplace pension as soon as possible because of the benefits based on employer contributions. So as we just mentioned, is a legal requirement for an employer to set or ensure their employees are opted into a pension. That being said, the benefits, as we mentioned, your employer would make those contributions into a pension pot for you, and also the benefits of the tax relief, the extra amounts that the government will put in. Start saving small and regular amounts. It's easier said than done. I do appreciate that. We do appreciate that in terms of being disciplined. But as we've mentioned, if we're talking about your regular person in terms of saving, not every person has a large amount of money that they can put away each month or each year, whatever their goal may be. So being disciplined and saving with small amounts and regular amounts still will have a benefit over a longer amount of time. We have briefly touched on it. We mentioned payday loans, high particular interest rates in certain products. Now, obviously, everyone has their own circumstances, but avoiding high cost debt is essentially not the greatest, especially if you're trying to achieve that long-term saving goal. High cost debt being high interest rates, that money could go elsewhere. So do make sure any loans or any debt that you do have, you do shop around and do make sure you're being as responsible as possible and that you can afford any payments back. Put some money aside as soon as you earn it. So everybody would like to be as disciplined. I'm guilty myself. As soon as my income comes in, I'm thinking about what I'm going to buy next, what trainers I'm going to buy, etc. It is much easier as soon as that money comes in for you to set that aside and you don't see it again. Once you've allocated that away, you're never going to see that again in terms of what if I had that money to buy on something else. You've established that's part of your savings and it will benefit you in the future. Finally, knowing yourself and your habits, know what's realistic in terms of your goals that you set. As we mentioned, if you have a particular interest in paying too much for coffees or you spend too much on clothes, etc., make realistic targets and work towards that goal in terms of achieving the goal that you want. Next slide, please. Right, so in summary, what we've discussed today, we've covered a few things, but generally speaking, it's about discipline and having that research. So it's important we ask ourselves what we're saving towards, whether it's a house, whether it's a cash amount to start a business, whatever that may be. We've got to establish exactly what we're saving towards so we can plan and see what products benefit us, how much we can put away, etc. How much can I afford to save? As obvious as it sounds, we need to be realistic. We can't stick to something in terms of putting money away each month if we know that's not going to happen. Obviously, being the current economy at the moment and current events, a lot of costs are happening in terms of unexpected costs. So we do need to be making sure the goals we have set, that they're not too strict or will impact you, or you can't actually achieve putting that much away a month. And finally, where should I keep my savings? Rohan mentioned before about diversification or diversifying or spreading your money. Diversification is always the best thing to do, but at the same time, where should I keep my savings, whether that's in a cash product? Rohan used that graph before about the various different products and their growth over years. So choosing where to put that money and where you should keep your savings is also important. So in summary, what we've covered today, and hopefully in the future with further events, depending on what happens later on, is stick to these three main points and to achieve the goal that we're trying to achieve in terms of saving for the future. Next slide, please, Rohan. Right, we will come on to Q&A in a moment. I just want to say thank you very much for joining. In terms of this presentation today, it is important that we inform you and give you that education and give you the opportunity to look into this. I just want to draw you all to these important investment notes. We do need you to read these just in terms of what we've discussed today. So if you could just spend some time and read these, and we will approach Q&A in a moment, and we can have a discussion and address anything that wasn't clear or something that hasn't come up later on. Thank you very much. And we'll just wait a few moments. Give it about 30 seconds, just so everyone's definitely had a read of that. Okay, we'll just wait.
All right.
Okay, Rohan, if you can get the next slide on
I'll
there.
bring up.
No problem.
Yes, I'll just bring up Slido in a second, and we'll be
Yeah.
using the Q&A function on Slido there. You can take a quick screenshot now if you want. That's the phone number for our help desk, and that's obviously my personal, my work email address as well. But to the Q&A. Now, I know that there are some questions in the
Text,
in the text as well. So I'll let Zane chair this, and you can bring me in whenever you want to, and I'll help out as well.
Yeah.
So go ahead,
yeah.
Sib. Sorry.
So yeah, if you've got any thoughts, any questions, anything that's kind of made sense there for you, to be really great to unpick some of those. So if you want to unmute, obviously just be aware of the background noise that's in your space. But feel free to have your camera off, your camera on, or unmute, so we can just have a little bit of that discussion about some of the stuff that you've heard. Does it make sense? Does it not make sense? Would you like to see more of this? Which sections actually more appeal to you, and so forth? That would really be great in terms of understanding how do we move forward with this. Is it something that you'd like to see, or was everything you've seen today all that you needed, and that's it, boom, boom, done, never anymore? All right.
Okay, so are you okay for me to start with the first question I can see from Sharon, or would you like to take it to the floor, Sibs?
No. If you can go ahead. We also have one in the chat from Michelle.
Okay, I'll start with Sharon because that's the first one I can see here. What's the APR? Do you want to elaborate on that? Are you referring to annual percentage rate of a particular product, or was that in between the questions?
Sharon, you want to unmute? Thank you.
It's just trying to know a little bit more the determining factors that causes the swing, how to recognize what's good and what's bad, that kind of stuff.
Okay, so hopefully I heard you. Sorry, it is Zoom, so the sound did come in and out. Hopefully what I heard was a bit more insight into what determines APR, what determines exactly what is offered, whether it's a credit card, etc. Is that correct?
Yeah, and also what affects it.
Yeah, I mean, ultimately, APR, if we're using a credit card as an example, it's the annual percentage rate. So what the lender, the credit card company, is prepared to lend to you. Now, a number of things can affect an APR. Ultimately, what that company is prepared to offer you that money, the rate in itself. What also could affect what would determine that is your credit score, how likely you are to pay that money back. And depending on the type of credit card that you've got as well. So I'm just using the example of a credit card here, but ultimately there's a few factors that will affect that. Generally speaking, though, the APR would just refer to the overall percentage that you're paying on the money that you're effectively borrowing from that company in that example of a credit card. Did you want to add to that, Rohan, at all?
No, I think that's pretty much covers it. As you say, it is. Oops, didn't mean to click on that. It is just basically how much you're going to pay on your savings to have them.
Yeah, I could add on that. And in terms of the credit score part, From my experience, and I'm using my own experience on this, is when my credit score was bad, any lender, even though they have their own interest rates, they would normally pick up the interest rate because they'll class me as a high risk individual, and therefore I end up having to pay more than someone else who is low risk because they've got a better credit score, which in a way I understand their business side, but then, you know, if I'm trying to improve my credit score by getting something and then they're making it more, it means I end up losing out more because of my credit score. So
Yes.
I think that's definitely something that then affects that APR is on your history of repayments according to what they've got. And it's worth checking with things like Xperia, and there's also other free ones. I forgot the free ones, where you can register to see how the financial market sees you as are you high risk? Are you a good payer? Do you have a portfolio? And even for my partner, my partner is a great a cash saver, or prefers to save money in a bank. And never really thought about credit cards. Always thought that her credit score should be good until we sat down with the bank and they told her my credit score is better than hers. And she's like, "But you've got all these debts." I'm like, "Yes, I've got a history. At least
Exactly.
they know how I pay. But with you, they don't know how you pay. Although you're good, but you don't have any credit cards. You've never taken on a loan. You've never done all these things. All you do is pay cash or use your debit card. So therefore, they don't know you, and therefore you're a good payer, but they don't know that. So therefore, you are still high risk." And that was pretty interesting, actually. With someone that I know doesn't have any CCJs, saves, but because they don't have that record, they had less of a credit score than myself. So that was interesting.
Yeah, there are ways to build your credit scores. There are credit builder, effectively credit cards. They have relatively high interest rates. But so long as you pay off your credit card each month in full, you don't actually pay the interest rate. So yes, it is important to look at the interest rate, but if you're going to pay it off in full each time, then that's not necessarily the only thing to look at with credit cards. Having your own mobile phone bill in your own name, that will also add to your to your credit scores and so forth. So just having effective direct debit mandates going in and out of your bank account is the way to start putting together your credit score. It's not fun, but it is important.
And also change of address.
Yeah.
If you change address frequently, like ourselves going through housing, if you change your address frequently, for them they see that as instability, and therefore thus they always want you to have a three years within an individual property. That also seems to kind of play against how they see that stability. Your individual situation may be that you are moving houses, looking for the right house to buy, or you were just renting for the time being and you've kind of moved from one to the next whilst that, but they don't see that. All they see is that you're moving around, and therefore so sometimes you have to think about which addresses do you change, and which addresses do you not change, and when do you as an example, we moved from a stable house where we were at for 3 years to temporary accommodation where we were at for 3 months, and then we moved to another temporary accommodation where we were at for a year. What I chose to do is I chose not to change my address where we were there for 3 months, because I knew that I'll change it once I'm in the temporary accommodation for a year. And what my partner did is she changed it when she was at for 3 months, and that changed, bank details, the car insurance kind of went down, and then when we moved again, the car insurance went up, so she had pay another premium. Now we've moved again, the car insurance went down. So I'm like, to avoid all those administrative things, you just got to know, okay, now I'm here, now I'm going to change. And you just got to plan when you change your addresses and how you change them. And also being on the register also made quite a big difference about our APR.
The electoral register, was that?
Yeah,
that matters.
Yeah.
All right, should we have a look at the next question then?
We've got, is the innovation finance ISA available now?
Yeah, innovative finance ISAs. Thanks for that question. We, Hargreaves Lansdown, were in the process of offering that. An innovative finance ISA, for anyone who's not aware, is effectively, it's still an ISA in terms of you still have the benefits of capital gains tax and income tax exempt from those savings within that wrapper, if you will. But that money that you're saving is lent out to different people, and the benefits of that is the gains, whether that's interest paid on the money that you've lent out, will all be added to the ISA. So there are innovative finance providers out there. Hargreaves Lansdown, I definitely know we don't offer that service, but it is certainly a product that you can take part in.
We've got another question there. Can you see it, Zay?
Yeah,
on the text.
The follow-up from TJ.
Yeah.
Okay, so TJ. Yeah,
No,
but people have told me, is that the one? 638?
Yeah.
Yeah, thanks, TJ. So people have told me that using your debit card can build a credit score because the history goes on Experian. Is that right or wrong? Yeah, I mean, there's a lot of hearsay in terms of what helps you improve your credit score. I remember hearing someone told me that this was hearsay again. I'm not too sure if it was correct, but ultimately the suggestion I got from someone was to have multiple banks and have that money constantly being standing orders, if you will, just going round. So it effectively shows you a lot of money's moving across multiple banks. Ultimately, using a debit card won't necessarily build your credit score, as far as I'm aware. It really need a bit more context there. But Rohan, do you want to jump in?
Yeah, I don't believe it does. So I don't use Experian. I've used a couple of other providers. There's three actual main ones: TransUnion, Experian, and Equifax that do credit checks. Yeah. I use TransUnion and Equifax, and they definitely don't look at your debit card. Experian, I'm not sure. I've never used. I've never had a credit check with them that I'm aware of. So they might be the exception to the rule. But yeah, as far as I'm aware, debit cards don't really help your credit score, or at least they don't help it much because you're not really taking out a debt there. I think the key point when you look at what credit is, credit is being lent money and paying it back. And with a debit card, you're not doing that. You're just spending money that you have in your bank account. And so just for that reason alone, even if it does show up on your credit score with Experian, it's not going to have the same impact as if you took out an arranged loan, if you had a credit card, because that is when you're actually borrowing and paying back that money.
Well, good point, TJ, because it's about hearing what actually benefits you and then hearing the suggestions that we definitely get from plenty of different people. So definitely a good question there. Right, looks like we've got Rushworth next. Hopefully I'm pronouncing that correctly. Apologies if I'm not. Can I trade stocks on your platform? Absolutely. Hargreaves Lansdown, as with the biggest retail investment platform, we offer hundreds, thousands of different stocks, whether that's the London Stock Exchange, various European stock exchanges, or if indeed the US. So absolutely, you are able to trade stocks on our platform. Not all. It really does depend on which stock you're looking at. For example, Chinese shares that are listed on a Chinese exchange or a Chinese market, we don't have access to that. So therefore, a client wouldn't be able to invest in a stock that's listed on a Chinese stock exchange, or Australia or South America for that matter, specifically with stocks.
You've got another one underneath that.
Yeah, I was just making sure Rushworth's happy with that answer. Okay, Michelle, what are your charges for advice to someone just starting out, looking to start saving for the future? Yeah, good question. Financial advice always does come at a charge. Advisors are professionals and they will give you that insight. Generally speaking, it depends on the type of advice that you do take. whether that's one-off advice, whether it's telephone, face-to-face, etc. I think the most important thing to understand if you are looking at advice is seeing if it's suitable for you. For example, I'm not too sure on the exact percentages, but we used to state around, I know, our particular advisors.
I can cover this one, mate.
Yeah, go ahead, mate. Jump in.
So your advice charges at HL are a £500 minimum. So it's 1% of the value that we're advising upon as a minimum, subject to £500. So if you are just starting out, then that fee can be quite prohibitive. Sorry to put it bluntly, but it can be to some people, and understandably so. Now there are different advice providers. You of course don't need to go with HL if you don't want to. But what I do say to everyone is that there is loads of different services and tools available, especially to people starting out on our platform and of course more widely. So you don't necessarily need to take advice immediately. So it really does depend on what you're trying to take advice on as to whether or not you need that in the first place. So what I would suggest to most people is basically say, or get in touch with me or with us and say, this is what I want to save towards, and then on a non-advised basis we can perhaps point you in the right direction as to what tools, what services and what web pages might be most helpful for you. You don't have to pay for that, and you of course get the information, so that might be a more cost-effective way to start. And then once you're quite happy with or once you've built up a small portfolio, then at that point paying for advice may tend to make a bit more sense.
Thanks, Rohan. Ribezzo, so we've got, we don't do crowdfunding, unfortunately, not with Hargreaves Lansdown, I'm afraid. And Rushworth asked about protection for investments. So good question. It really does depend on the type of investments that you do have, but I'll generally put it in an umbrella form, which is known as the Financial Services Compensation Scheme. So that's set up by the government, and it refers to two elements of savings or investments, if you will. There's cash, and then there's investments. So from a cash point of view, the Financial Services Compensation Scheme effectively covers anyone who holds money with a bank within the UK, which has a banking license, otherwise they wouldn't be a bank. They are covered up to £85,000 per investor per bank. So that's how it works with cash. So for example, any bank that's practicing within the UK will have the Financial Services Compensation Scheme for cash. From an investment point of view, it does depend on the types of investments, but generally speaking, if we state investments, stocks, funds, or whatever you refer to, Financial Services Compensation Scheme technically does cover you on investments. However, the caveat there, the protection is only if there was effectively malpractice. So I always use the example of a fund manager. So Rohan mentioned that before, not a specific share in a company, more a collective pool of investment where you would put money into a fund and that fund manager would hold that. So the Financial Services Compensation Scheme, from an investment point of view, covers investors in the event of malpractice. It wouldn't cover you if you put your money in a share and it just happened to go down. That is the risk of investing. So yes, there is protection, but it does depend on the type of investment and how and the context of what happens.
That's great. That's great. Yeah. Yeah. Do you have any final thoughts?
I've got a few points to make, if that's okay. But
yeah, please, mate, go for it.
Yeah. So generally speaking, thank you very much for everyone here joining the session today. Hats off to Sibs and Rohan. Put a lot of work into this, and you're all incredibly lucky to have someone like Sibs who really does care about the community and is all about empowering, particularly the BAME community and within our own communities. it is important. Although this is highlighted as Black History Month doesn't need to be once a year. It can be every day as far as empowering ourselves. So it's important to, myself and all of us are very happy that we've informed you on this today and given that education to everyone, as it's a right. All of us do need to have that access to that information and do have the confidence to better yourself. Anybody? Sibs, Rohan?
No, yeah, hopefully you all found that helpful. Thank you for all your questions. Sibs, I will email you the presentation tomorrow. I'll send it to you in a PDF. You're welcome to share the PDF version. So I can just see it's being a few questions being asked about that. So yeah, so I'll send that over. And then you've got my email address there. You're welcome to send me an email. That phone number goes directly through to our investment help desk, who are really well armed to answer almost any of your questions. And if they can't, they have all the resources to point you in the right direction as well.
Absolutely, absolutely. So it will be the presentation, and it will be a personal budget support plan. I've also found like things like what is it called? Monzo accounts have been really, really helpful in terms of just knowing where you're spending and how much you're spending, so you can start savings and thinking about things, because it just gives you a good budget breakdown about grocery shopping, petrol, and these kind of things, you know, without really having to look at your bank statements. That's really save time in terms of discussions. But, you know, there's nothing more than seeing more wealth development within our communities, both from businesses and from personal finance kind of management. That's really the key here. It would be great to have, you know, a millionaires club or a wealth club that kind of kicks off at the basis of, you know, how do we take £5 and we're chipping in £5 there, chipping in £5 there, and actually then feedback about, you know, my £5 has grown into this, my £20 has grown into this, my £1,000 has grown into this, so I've lost this, you know, and I've learned this from doing X, Y, and Z. Because, you know, one thing my mom tells me is, you know, if your friends don't talk about money, they're not really your friends, because you're just talking about spending money, but you're not really talking ever about making money, about growing money, about developing and things like that. Then it's just a different crowd. And as you can see from everything that's happening around coronavirus and everything else, you're talking about health inequalities, you're talking about the impact on Black and Asian communities. But majority of all of this is showing the wealth gap. It's showing the inequalities financially. You've got the gender pay gap. You've got the ethnic pay gap. You've got all of the, you know, educational attainment gaps. You've got all of these gaps. So, you know, unless we're talking about finance, unless we're talking about financial management, unless we're talking about financial literacy, we are not necessarily tackling this wealth gap and creating that wealth kind of gap where you're leaving legacies for your children and your children's children, because that's where wealth is. And one of the things that my mentors say is, how long can you stay out of your business and it manages itself? 2 weeks, 1 week, 3 weeks, 4 months, then that's how much money you've got. But then when you think about your family, if you had to stop working, how many months or years could you survive? Yeah. And when you start thinking about things like that, that's when you then, you know, as those 3 steps were, it's about that goal in mind, right? I want to stop working at 55, but I want to be able to live off my investments and everything else. So what do I need to do now so that I'm able to do that lifestyle at 55? And therefore I need to sacrifice X, Y, and Z. I need to not wear designer shirts. You know, maybe I'll wear, you know, good things for work because I want my business to grow. But personally, I don't really care about the brand, because the brand is going to take away money from my children to be able to go to private schools or to be able to do this. You know what I'm saying? So these are the things that we got to really think about, is what's the long term? What are you working for now that will make sure that you sacrifice automatically because you care so much about it? So think about your goals. You know, there's nothing more that will help you to save or to put that £50 away or £80 away or £100 away than your goals. and no one else will hold you accountable unless we are a network that holds each other accountable about our goals. Because if your goal is only to yourself and you're not accountable to others, and you don't speak boldly about your goals, then if things don't go right, then it's only you that knows. Yeah. And the thing about a goal is, if people don't laugh at you about your goal, then your goal is not big enough. Yeah. Someone's got to look at you and say, "You're joking. You want to do that? How are you going to do that?" Then you know your goal is big, right? Because someone doesn't see that that is possible within what you are doing. Yeah. But then that's the aspiration. That's the growth. Then you got to find that network of people that believe that you can do that, right? Believe and push you towards doing that and ask you every single month, "So how far are you towards your goal? You said you wanted to do this next week. Where are you right now?" They're just holding you accountable. You know, there's no one to get mad at. They're just holding you accountable to what they've heard you say. Yeah. So, you know, spread your goal. Be bold about your goal, because the more people that know your goal, some people will hold you accountable, and that's just going to keep reminding you about that burning desire within you. So thank you guys. Thank you for actually being around to put that education out there in that formal way with your expertise. And let's find a way to create a platform where we can talk about money. Yeah. Let's get to that point where we can talk about money. But yeah, if you have any comments, any things that you guys want to say, you know, before we wrap up, that'd be great. Okay. No comments, no suggestions.
No, I can say thank you very much for organizing this, Sibs. And I just saw, I think, oh, let's give you some support, but it's a very nice platform. And I think without knowledge, people perish. So this one way of rescuing. So thank you with your colleagues as well. It's really great. Thank you.
No problem, Sharon.
Right.
Thanks for joining. Thanks for joining.
Bye.
Thanks for all the young peeps for being involved. Wow, man. If I only stuck to my piggy box, yo, I'm telling you, sometimes I had to break it in, you know. Try not to break into your piggy box. Definitely try. Yeah. Mr. TJ, thanks very much for your questions, mate. That's really been you know, thought-provoking in terms of that. And obviously, you know, you're picking up some questions, some suggestions from others. You've heard it from the professionals about some guidance there. You know, take the advice, don't take the advice. Yeah. Rabetswe, Tsakofatso, Olu, thank you very much for joining. Muna, thank you very much for being part of this, and definitely let's spread the word to our community. Let's spread the word to other young people. As you can see, this is both useful for, you know, any age group, but as we develop it, we'll really make sure that it's kind of tightened up, that anyone can pick up on this knowledge. It's not for the rich and wealthy, but we can all get to the rich and wealthy, you know, one step at a time. Brilliant. Thank you. Take care.
Night.
Nice. Bye. Thank you.
Cheers. Zain, you want to just stay on for a bit?
Sure.
All right. Cheers.
Hello.
Yes, Mama.
Hello. Hi. Just I missed the first bit. I came to the session quite late, so I can see it's recorded. Can you email us or?
Yes. Did you register on the Eventbrite?
Yeah, I registered. Yeah, I got it through an email. Yeah.
Okay, no problem. In that case, I've got your email address. We'll send you the presentation, and we'll also send you the
slides. Yeah.
Yes. All right.
Okay. Thank you so much.
No problem, Mama.
Thank you. Thank you very much.
Cheers. 26. Naomi, thank you. I'll give you a call. Thanks for joining. And Rabetswe, thank you. I hope that's been useful. Please start saving slowly. I know you're much better at this than I am. So take that on board. All right. Okay.
All right. Thank you. Thank you very much.
All right. No problem.
It's been a wonderful session. Thank you.
What did you like about it?
I personally actually liked the part where, you know, your investment are secured and how to start with your investment, because, you know, with the millenniums, they're always like thinking of, you know, these fancy things and, you know, driving fancy cars and not thinking of investing. So that was quite interesting to me as to how exactly one can start at a very early age, so that you know that when you retiring or when you're planning retiring early, you know that you've got, you know, like a backup. You will be fully taken care of in terms of your finances. And yeah, that was quite interesting.
No problem. I'm happy that it's been useful. Thank you.
Thank you.
All right. And you, Roberta?
Now, my favorite, it's very nice to see that not everything requires for you to be a certain age to start something. And I've always liked the idea of having more than one income. So knowing that I don't have to wait to get there, I can get there like recently, is honestly one of like, that was my favorite part.
Yeah, I mean, like if you think
Being
of
educated.
buying sneakers, right? You could think about, you want the sneaker that's this much, but actually if you save half of that and buy this sneaker, automatically you've made a savings, you know?
Yeah, and my favorite thing to when I always think about saving is save money so that money can save you.
Yeah, that's the quote for the day.
Yeah.
Save money
Okay.
so that money can save you.
You should have copyrighted that. He's stealing your thunder there. He's writing it down.
Please.
Yeah.
Okay then, thanks.
Thank
All right.
you.
Bye.
Bye.
Take care. Bye.
Some copyrights there. I think they're just about to come off. Yeah. Yeah, mate. How do you think that went?
Yeah, happy with that, mate. Thank you very much. Just good to see we've got some communication, because at the end of the day, that's what we intend